Hello and welcome to the lecture for Chapter 17. This is our last chapter of the course, and I will get through this in one lecture. So I think this is actually one of the most interesting chapters in the entire book. One, from the standpoint, if you're going to be an accountant in the future, this is really important because this is going to be, these ratios and this way of analysis is going to be how other people judge your company, the company you're doing accounting for. From the other standpoint, if you're not going to be an accountant, this is also very important because this is what you would use, these methods are what you would use to determine if you should grant somebody credit, if you should invest in a company, all of those kinds of things. So I think this chapter is useful for everybody that studies business. It's also very important for any kind of organization, for profit, for not-for-profit. I've used the methods we'll talk about here in a wide range of little businesses and big businesses alike. So financial analysis is used by external parties and by management both. So external parties are going to use it to, one, assess investment opportunities. Should I put my money in company A or should I invest my money in company B, as an example, and to determine creditworthiness. And determining creditworthiness is not just something that a bank does. Of course, a bank does that, but for example, I did that in my company when a customer would ask for credit from me. I would examine their financial statements to try to determine, am I going to get paid back by this customer? So a wide range of external parties use it. The management within a company will use this kind of financial analysis, one, to uncover trends to see if there are problematic areas of the company that need more attention, to make sure they comply with covenants, and covenants are the requirements set out in most lending agreements that say you need to meet certain criteria in order to maintain your loans with a bank. So a lot of those are based on ratios that we'll talk about. Another is preparing for questions. So if I do the same kind of an analysis, if I'm a controller in a company and I do the same kind of analysis that I believe external parties are going to do, then I'm going to determine where there are issues. I'm going to develop answers for those issues before I'm in front of those stakeholders. And then lastly, we might find and correct errors. If our gross profit margin is always around 52% and 1 month it's 65%, well, then maybe there was a mistake in how we counted inventory, or maybe there was a couple of transactions that we didn't recognize cost of goods sold for. So those are all different reasons that we would do that. So the types of financial analysis that we'll go over, first I'll talk about horizontal, vertical, and common size analysis, and then we'll talk about ratios, which include liquidity and solvency. Liquidity is our ability to pay bills as they come due. Solvency is our long-term ability to stay in business. And then profitability analysis. So horizontal analysis is what it sounds like. It's comparing things horizontally across each line. So here I've shown an income statement for 2 different years, 2013 and 14. So as an example, 2014, the sales were $296,500 greater than 2013. So it's always the most current year minus the year prior to that. And the percentage is that difference divided by the base year. So a 24% increase in sales means 296,500 divided by 1,234,000. And we do that down the entire income statement. We could do this for balance sheets as well. So where we get meaning from this is I'm able to say, well, sales increased by 24%. That sounds pretty good. Our sales returns and allowances were lower, so our net sales went up even more than our gross sales went up. But what's problematic here is that our cost of goods sold went up 27.2%. So our cost of goods sold is going up faster than our sales are going up. So that's problematic in the sense that if that trend continues, we may have some problems. The other area that jumps out at me here is selling expenses. Why are they going up greater than sales are going up? That is also potentially problematic. It doesn't necessarily mean that somebody did something wrong, but it's a starting point for a question to say, is this a one-off situation or is this a trend that we need to be aware of, that we need to plan for? Vertical analysis instead looks at each item relative to one single item on the income statement. So in this case, it's sales, or rather net sales is 100%. So every other number is expressed as a percentage of our net sales. So, and again, we compare 1 year to the next. Having just 1 year by itself doesn't really tell us much. So in this case here, if you go to the cost of goods sold line, you can see that in 2014, cost of goods sold was 69.6% of sales. Last year, it was 68.3. That's another way of looking at that negative trend in cost of goods sold that I mentioned. Same thing with selling expenses. This year it was 12.8%. That's 191,000 divided by 1,498,000. Last year it was 12.3, so it's gone up a half a point. So that's another way of looking at things to, again, identify trends or patterns or items that stick out as maybe being potential problematic areas. Now, I could take that percentage column and we could do something called common size analysis. So I took the percentage column for Lincoln Company and I can compare that to the same information for Madison Corporation. Madison Corporation might be much bigger than Lincoln Company, so it might be difficult to compare dollars to dollars. But by comparing percentages, I can see how do we compare to Madison. If Madison is my benchmark, where am I better and where am I worse? Where might I need to look at saving money or improving the efficiency of my operation? Now, it's important, of course, that Madison be in the same line of business as Lincoln. You can't compare, a car dealership with a retailer or something like that. But in this case here, assuming they're similar companies, we can get a lot of information from this. There are websites that you can go to, and bizstats.org or bizstats.com, bizstats.com has a ton of ratios like this for all different kinds of businesses. That can be a good way of looking at your company's financials to say, how are we doing compared to a benchmark? Now, current position analysis, this is now ratios that we're talking about. Well, the first one isn't. Working capital is the dollar amount that is current assets minus current liabilities. The current ratio is a very common ratio to look at. It's a really good ratio to look at in terms of deciding whether or not you're going to grant somebody credit. In that case, we divide current assets divided by current liabilities. So a bigger number is better in this case. A good rule of thumb is most businesses should have at least a current ratio of 2.0 or greater. The quick ratio is a little bit more severe kind of analysis. So instead of looking at all current assets, we just look at current assets that are very close to cash. So cash, marketable securities, and accounts receivable. Look at just those three compared to the bills that are coming due. This will tell us if a company can pay their bills as they come due. If a company had a current ratio of less than 1.0, I would not consider granting them credit. Accounts receivable analysis is also very interesting. Some companies calculate accounts receivable turnover. That's how many times we're turning over our receivables each year. If we were turning them over once per month, then we would have a turnover of 12 for the year. That's net sales divided by average accounts receivable. More interesting, though, is days sales in receivables. This tells you the average age of a receivable in your system. Here we divide the average accounts receivable, so it could be all 12 months added together divided by 12, or beginning plus ending divided by 2. And we divide that by average daily net sales. So we take the total credit sales for the year and divide by 365. The thing that's interesting about this is we can compare that to what the company's credit terms are. So we'll get a number like 35 or 40 or 42. That's how many days old the average receivable is. Well, if their terms are net 30, that tells me that they have a problem collecting from their customers and they need to improve their efforts in that area or improve how they grant credit to customers. Similarly, we can look at inventory the same way. We can either look at inventory turnover, cost of goods sold divided by average inventory, or we could look at how old the average item in inventory is. So we could divide average inventory divided by average daily cost of goods sold. So cost of goods sold divided by 365. Now, we can't compare this number to a policy of the company like we could with receivables and credit terms, but we can certainly look at what are the trends. Is it improving? Is the number going down? So here a lower number is better, or is it going up? Is our inventory becoming more stagnant? If a company came to me and said, boy, we are profitable and our sales are increasing, but we never have any money, We're always scrambling to be able to pay our bills. I would look at these two ratios, accounts receivable and inventory. Look at those two numbers because trends there are most likely going to be where their problem is. Next one is leverage analysis. So to what extent has the company financed their fixed assets with long-term liabilities? That would tell me how much room they have to go. Okay, and in this case here, a higher number is a better number. We can also look at liabilities to stockholders' equity. That's another, also called debt to equity ratio. This tells me how leveraged a company is in total relative to the value, the claim that the shareholders have on the company's assets. The thing here is the higher the number for the ratio of liabilities to stockholders' equity means a company has borrowed more relative to what owners have put into the company. What that means is they're going to be less able to weather a financial storm. If there's a recession or a downturn in the economy or challenges to their business, they don't have the room to be able to borrow more money to survive the problem. And on top of that, they have to make loan payments. So cash is flowing out to service the debt when they need it in the company. So in this case, a higher number is riskier and not as good. The number of times interest charges are earned, in this case we'll take income before tax and add interest expense to that and then divide by interest expense. This is primarily important for companies that have a lot of bond debt. Are they able to service the interest on their debt? And a higher number is better in this case, meaning they're earning enough to cover the interest that they have to pay out multiple times potentially. Profitability analysis, one, we can look at net sales relative to assets. So when the company purchases assets, are those assets that produce sales for the company? Hopefully they're not buying machinery that's being mothballed and not being used productively. So how productive are the company's assets? Again, it's good to look at this over time to see is it getting better or worse. It's good to look at this relative to other companies or benchmarks to see are we better or worse than other similar companies. We can also look at the rate that's earned on total assets. So we can take net income plus interest expense and divide by average total assets to see are those assets, not only are they producing sales, are they producing profit? Next one is the rate earned on stockholders' equity. So we take net income and divide by average total stockholders' equity. That says if a stockholder gives us $1,000, how much net income will that $1,000 provide? How much will it produce? So are we taking that money and using it in a profitable way? The rate earned on common stockholders' equity would exclude the dividends paid to preferred shareholders, and the denominator would just be average common stockholders' equity. The earnings per share on common stock is a really important criteria because outsiders very frequently use this. You probably have heard earnings per share talked about when they talk about publicly traded companies. So in that case, we take net income minus preferred dividends and we divide it by the number of shares of common stock that's outstanding for the year. That says how much net income is associated with each share of stock. And again, is that getting better or worse? How is it compared to our competitors or a benchmark? The price earnings ratio, or the PE ratio, is really important. That says how speculative is the market price of this stock. So we'll divide the market price per share, that's the price that's quoted in online or in the Wall Street Journal, that sort of thing, and divide it by the earnings per share on common stock. Now you can only do this with companies that have a market price for their shares. A small little company wouldn't necessarily. But this would tell you, is the market pricing this stock based on a lot of speculation about huge profits in the future, or is it based on how the company is doing today? And again, compare different companies, compare how things have changed over time. What direction are things going for this ratio? The last couple I have here, one is dividends per share. That's dividends divided by the number of shares of common stock outstanding. If you're nearing retirement and you're purchasing shares of stock that are good dividend payers like 3M or other big established companies like that, this tells you what kind of return you're getting. If I buy $1,000 worth of this company's stock, how much am I getting back in terms of dividends each year? And you can compare that to, well, what if I bought bonds that paid 5%, or what if I had certificates of deposit that paid some percentage? I could start to compare the profitability of different kinds of investments. And then I can look at that relative to the market price, so I can see what each share is yielding. Last thing I want to talk about is the company's annual report. So a company's annual report is going to include more than just the financial statements. So the year-end financial statements will be there, but then there'll also be a section called Management Discussion and Analysis. So that's where the management of the company explains any kind of significant developments in the company, new products that they're about to launch, new markets they're going into, challenges. I'm sure there are a lot of companies that are talking in their annual reports now about the effect that COVID has had on their earnings and on their company, those kinds of things. They'll talk about any significant accounting policies, significant changes to accounting policies. They'll assess their liquidity, or how are we doing in terms of paying our bills, and are things good that way. They'll discuss any kind of significant risk exposure that the company has and what they're doing to mitigate that, and then any off-balance sheet arrangements. So do they have any kind of creative financing arrangements that need to be explained. They'll also provide a report on their internal control. So what systems do they have in place and how strong are those? And lastly, it'll include the auditor's opinion. And that's the role that outside accountants have in the company. And the way I can best explain that is, if I had a company and I wanted to borrow money and you were my bank, and I came to you with financial statements that I produced, maybe in Excel or something, and I gave them to you and said, can I please borrow $1 million? Well, of course, maybe I would make those financial statements look better than they really are because I want that money from you, right? So you may be reluctant to loan me money based on information that I've given you. You'd feel better about it if an independent third party looked at that information and blessed it, said that, yes, this is accurate. So that's the role that outside auditors play. So I would hire a CPA firm. They would come into my company, and they would look through all of my financial statements, all of my financial records. If I say that I've got $500,000 of accounts receivable, they'll randomly choose customers, contact them directly, and get verification of how much the customers owe me, and see if that agrees with what I say. They'll look at records to see, when I say I've made a sale, was it really a sale? All of those kinds of things. They'll look at all of that, because at the end, they'll produce an opinion that gives assurance that my numbers are correct. So they're taking some of that risk. Now, if I come back to you with financial statements and a letter from Moss Adams or Price Waterhouse or some other auditing firm that says these financial statements are accurate, we've done a lot of tests, we believe they're accurate, now you're going to be much more comfortable loaning me money, hopefully. So that's the end of this lecture. If you have any questions, please don't hesitate to reach out. And thank you very much for your time and attention in this course. I've enjoyed it. Bye-bye.